long-term yields break higher as the FOMC minutes show a rapid pace of QT may be coming. Stocks roll over, led by tech and mid-caps, and bank earnings kick off the season, where guidance will be key. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 12th of April, and let's take a look at these markets. So last week we had US 10-year rates up pretty big in the order of magnitude of 30 basis points, or a touch more actually. We'll bring up this chart. We can see here you've got 3 sigma move in the 10-year. And then, lots of other sort of rates curves moving along as well. New Zealand, Sweden, things like that. What else did we have going on? Obviously, you had central banks getting more hawkish. You had Brainard talking about QT kicking off in May. And so that's what kind of drove the move. That's the largest weekly increase in US 10-year yield since 2016. And then you had the sole exception there. If you look at the other side, all the rates are up. That's all the blue bars. And you've got one massive blue bar on the way down. And that's Japanese 2-year rates as Bank of Japan stays dovish and takes their 2-year down about 3 sigma, right? So they're standing firm on their yield curve control in the face of what's going on. They basically want to import some inflation into Japan, it seems, right? Now, as a result of the rates move, equities were hit hard. Biggest sort of big cap tech getting whacked. So you can see in the equity, the orange bars, we've got the likes of Amazon, Google, Microsoft all getting hit. And the NASDAQ there as well, down anywhere between 1 and 1.5 sigma move. And then in currencies, we had the euro and the yen down, still sort of heavy in line with recent price action as the Fed policy is coming in more aggressive than, say, ECB or Bank of Japan, obviously. It'll be interesting to see what comes out of ECB today in terms of the press conference. I think it might be ongoing now. See if we get any move in euro there. But in general, it just seems the market has got this sort of feeling that the euro's just got a lot of headwinds, right? Whether it's the Russia-Ukraine stuff, throwing Europe potentially into a bit of a recession, whether it's the risk of Le Pen coming through in the French elections, and we'll talk a bit about that in a minute. But these are the type of things that are kind of weighing a bit on the euro. And then commodities kind of having smaller vol-adjusted moves than what we've been seeing lately, but quite a bit of dispersion going on within commodities, which we'll talk about a bit later in the call. Okay, so that's what we're seeing across all the kind of major movers. So the big thing over the weekend was the French election. You had a little bit of risk creeping into markets going into the weekend. People kind of, nothing really quite as dramatic as 2017. But if you see here, obviously Le Pen came out second after Macron. He was in at about 28%, she was at 23%. But if you look at what was going on in the peripheral bond market, and that's typically where this stuff tends to get priced, this kind of euro redenomination risk. Yeah, you saw a move up in Italian, Spanish, and French yields relative to German, right? So that's what we saw happen there. I think that has kind of probably subsided a bit. I haven't seen the latest move sort of yesterday, but the second round now on the 24th of April is going to be key. There probably will be still a bit of risk premium in there because anything can happen, right, in a 2-horse race. And a lot's going to kind of depend on turnout and things like that, right? So market might actually be still underpricing the risk if you compare it to what was being priced in 2017. And you might see peripheral spreads blow out a bit more as we head into that second round. It might be, though, that Le Pen might not be quite as anti-euro as she was 5 years ago. So that might actually help her chances, right? But that's definitely something to keep on the radar and something to be aware of that's coming up in a couple of weeks. Yeah. So clearly it was the 2-year that's been driving things so far this year. Now, finally, the long end starting to break, right? So you look at the value of global bonds, they've shedded about 6 trillion since kind of middle of last year. And if you look at the US 30-year, that's kind of really testing against this downtrend, right? This chart of truth that Raoul Pal talks about. The 10-year downtrend looks like it's already kind of gone. I guess, it's not a conclusive break when you zoom out this much, it's hard to say. But US 10-year above 3 would be a pretty conclusive break. And this 30-year is kind of really testing the boundaries now. Okay. Why is it happening? Because, the Fed obviously is behind the curve and they're talking way more aggressively, but not just in terms of rate hikes, but in terms of balance sheet reduction, right? That's really the key here. How much are they going to reduce the balance sheet? How much, how many treasuries are going to hit the market in the next year or two, basically, right? And the market needs to reflect that. At first, the market was, pricing the long end on growth expectations, but now the market is starting to, in the short term at least, look at the idea of, these long end yields might be breaking out. Inflation expectations are going higher in the longer term. And, how high could yields actually go, right? So that's kind of what the market's focused on. To that question, how high could yields go? You've got a couple of big banks that are just calling for the end of it now, basically, right? They're saying that, yields have kind of gone back towards fair value. So you've got JP Morgan. They've got a model that they run to kind of figure out what the fair value is on 10-year. We've kind of gone back towards fair value now. What is that based on? That's based on various metrics. We can see here, they do various regressions on 5-year tips, break evens. They look at Fed policy guidance. They look at spec positioning, all sorts of things, right? So their model's suggesting that 10 years kind of done what it's needed to do. Goldman's are also, their kind of projection, their forecast was around 270 on the 10-year as well, and we're already there. So they're saying we don't need to go anywhere else. Now, who knows if they're going to be proven right or wrong. The chart on the bottom right is quite interesting. That's basically, that's macro bond pointing out that once the yield curve inverts, as it did recently, typically long bond yields don't typically rise much further than that, basically, right? So wherever they are at the point where it inverts, they often tend to cap out there, okay? And that's based on data looking back to the 80s, right? And I guess, the conclusion there would be that once they invert, because we then often typically head into a recession, then you don't see that long end really going much higher in terms of yields, okay? The flip side argument to that would be something along the lines of what Macro Hive are talking about now, that they're sort of, their analyst coming out recently with a note saying that she believes that you could see US rates needing to go as high as 8%. So it's a pretty out of consensus call there, and it's way beyond what the market's pricing as a terminal rate, which is around 3.5 at the minute. But she's basically looking at this thing called the Taylor rule for the Fed funds rate, and basically saying that looks at the deviation of inflation and unemployment from long-term trends to get a gauge of where rates need to be. And she's looking at the difference between the Taylor rule Fed funds rate and the actual Fed funds rate and how wide that differential is. And it's kind of as wide as it's been since the late 70s or whatever, right? So she's saying that this is different to normal, unlike what Macro Bond is saying, and saying that, yes, rates do need to go a hell of a lot higher, right? Remains to be seen, right? If the growth slowdown that is inevitably coming, if that makes inflation come down enough, then I doubt we're going to see anything like those type of rates, right? But if despite a slowdown, we see massive inflation, which some macro guys are calling for, Julian Brigden sees inflation to be very persistent as well, and he's a very solid macro guy out there that I follow and pay attention to. If they turn out to be right, then who knows how high yields need to go, right? And we may not be done yet. Right, so something to definitely be aware of, that there's quite a big tail now to how high yields can go. And just from a technical perspective, people might jump on it, right? If the technical downtrend breaks, people might jump on that. And before you know it, we see, 4% on the 10-year, right? Which is the kind of thing Joseph Wang's been calling for, the Fed guy, basically, who appears on Blockworks a lot. So yeah, keep an eye out for that. But there's such a broad range of potential outcomes in rates, is kind of my takeaway, that I think rates vol is just going to stay very, very high. Yeah, so don't expect the move index to come down anytime soon. So this is kind of the S&P chart. and we can look at it on a couple of time horizons, right? So we obviously topped out there just above 4,600, and now we've kind of rolled over a bit, obviously on the higher yield, spooking the market, and we've pretty much touched this 43.85 support overnight, which is the 50% retracement of that rally, right? And we staged a reasonable bounce off there. Okay, so that's kind of what we look like on a sort of zooming out basis. If we then drill down into the more intraday and what's been happening, we kind of have a look at what spot gamma's levels have been and things like that. So the market kind of capped out at around 4,600, which was kind of that core wall area. And you saw that sort of this time last week. And then when Brainard said her piece, the market started to roll over. And we'd kind of said that, you know, if 4,500 breaks, then the market positioning flips again. And you're probably likely to see a bit more sustained choppiness and a bit more volatility, right? And that's kind of what's happened. We then broke that level, and then you can see the candle. These are hourly candles, right? So you can see the hourly candles have been getting bigger, and the market's been a lot more choppy because you've had less stability. You've had less long gamma positioning, if not short gamma positioning, and the market's kind of scrambling really against that positioning as we've been seeing since the start of the year, really, right? Whenever the street gets caught a bit short. And then now where are we? Well, we were breaking that 44.40 area, which I kind of flagged as a bit of an important area last week. We've just bounced literally as we speak back up to that. This looks like probably an important resistance now. Used to be support around here at 44.60. We'll see if that fails or not. But, you know, I'd say a slide down towards what looks like spot gamma's put wall down at 4,300. Might not happen this week, but definitely seems to be on the cards. You know, I mentioned on the Discord today that I think in general, rallies are probably for selling at the moment in equities. You know, obviously, if we were to break above 4,600 and something changed, but that did seem to cap the market. And that now I do think that, you know, that kind of selling rallies dynamic is going to probably be firmly back in place, right? So those are my thoughts there on the S&P price action. In terms of other indices and stuff, obviously the tech, the NASDAQ getting whacked pretty hard. Mid caps also, the Russell, both down about 4 to 5% alongside China as well. So those are the weakest last week. You had Europe doing a bit better. You had UK small up 1%, and then European broad indices only down 1 to 2, which, you know, is an outperformance, but it's still an absolute negative. What's been weighing on China? These COVID lockdowns are getting ridiculous. Shanghai's basically locked down 100%, it feels like. Economic activity obviously taking a hit there, and this sort of self-inflicted pain that China are putting on themselves. Whilst they've been talking up markets or trying to, we haven't seen any of that loosening that's been promised. As Darius from 42 Macro has mentioned, you know, it seems to be all talk right now. So China, don't know what they're doing over there, but, you know, for what is arguably a virus that is not a lot worse than a cold these days, locking down their entire economy, you know, it seems to be a self-inflicted, you know, shooting themselves in the foot. Not really sure what's driving that there, right? Some people are arguing it's like some kind of test to see, you know, how much the people will do what they're told, right? So remains to be seen. So that's kind of broader indices. If we then have a look at volatility, what we're seeing in vol markets, if we bring up the kind of VIX and some of the positioning, as I already mentioned, you know, we seem to be in short gamma territory according to, you know, spot gamma's metrics. We did see a bit of flow late yesterday. Now this hero indicator here, this kind of shows as the market trade opened down or traded down, the flows were not particularly bearish. So you saw put selling, that's this blue line going up throughout the start of the day or most of the day. Call flow was quite benign. And then all of a sudden, towards the end of the day, you saw a load of put buying and a load of call selling, right? So you definitely did see, as the market broke down later in the day, you saw option flows kind of confirming that, and you saw some protection buying kicking in, basically, right? If you look at the VIX, you know, we had flagged that support around 18. That seemed to be the level. Bounced nicely off there back into the sort of 20, sort of mid to low 20 area on the VIX. If you look at the VIX term structure over the week, started off as the green line, quite steep, is now flattening back off again, basically, right? And I would expect the VIX to probably not smash back down through 18 in a hurry, just because now that 1 month window that the VIX kind of represents captures the May FOMC meeting, right? So, you know, if that is the meeting that's going to trigger QT and stuff like that, maybe the market's going to assign a bit more risk premium to that event, basically, right? So I kind of think we may have seen the short-term lows in the VIX there, basically. You know, they have bank earnings are expected to take a hit, right? So investment banking, look here, investment banking revenues are expected to be down something like 26% in Q1. So that's not great, obviously. Earnings sentiment has been crashing. So if you look here, S&P, Stock 600, Topics, MSCI emerging markets, all been rolling over sort of since November, really. So they're all, you know, people slashing estimates. So you might see actually Q1 come in sort of in line, right? Because estimates have been slashed. But really it's about Q2 guidance. So if you look at the bottom two charts, you've seen this drop from sort of Q4 down to Q1, but now what is Q2, 3 and 4 going to look like, right? So, you know, analyst forecasts are that they're going to start growing again. And that's a little bit at odds with the idea that, you know, we're heading into a slowdown and things are going to get worse, right, before they get better. So I'd be surprised if this sort of earnings repricing has done enough and now things are going to be plain sailing into the end of the year. So it does look like Q2 to Q4 is probably still a bit too optimistic. But, you know, there's been a bit of de-risking in the market. So I think we kind of need to see how stocks react. What sort of guidance are we going to get out of the likes of the banks and how are stocks going to react, right? But, you know, it does seem like things are too optimistic. And the only way to really justify those numbers is if the commodity sector earnings are just complete blowout and basically make up for the shortfall in everything else, right? Which they may well do, but I think that's what the market kind of seems to be pricing in at the moment, right? The commodities are going to, you know, be making stellar numbers whilst everyone else is coming down a bit. Yeah. So those are the things I think are going to be need to watch out for in earnings. So I kind of flagged this in my macro tweet over the weekend in my tweet thread. So this is the commodity dispersion that we saw last week, right? So you had the likes of natural gas, wheat, palladium all flying. Obviously supply constraints, things like that, driving things there. But then on the downside, we're seeing crude obviously get hit, aluminium, copper, things like that. So those are all linked to kind of Chinese demand destruction, right? So given what's going on in China, you know, the weakness coming, and also the SPR reserve releases coming from everywhere, right? That's kind of, you know, giving a bit of pressure to the oil market. But it looks like it's kind of starting to stabilize, right? WTI at around 95. And Brent at around 100. So that's where the selling is coming from on commodities. But like I say, on the upside, nat gas, you know, wheat, things like that. I'd mentioned wheat is going to be a function of fertilizer, and I don't think the problem's gone away and is going away anytime soon. So and then palladium obviously has got some issues as well in terms of Russian supply. And then obviously natural gas, right? So we talk a bit more about natural gas, but US natural gas up 15% on the week. Pretty impressive performance. The chart's going a bit parabolic, partly because of this kind of idea of some sort of convergence between European and US gas markets. Now, that's, if you look at the bottom right small chart here, it's still miles away, right? We're talking about US natural gas at $6 and the equivalent European being above 30, so it's still 5 times that, but it still is the idea that there's going to be a substitution effect, right? So there's going to be, you know, for example, there'll be demand for the US to make fertilizer using their natural gas and things like that. Obviously, Europe's, you know, talking about getting more natural gas from the US, and this LNG total net flows is showing the exports of natural gas are rising. So that as that number's rolling over, that is the exports rising. So it is happening, and that is why we're seeing the price going up, right? How far this price can run, I have no idea, but it has gone a bit parabolic in the short term, basically, right? US nat gas as a function of what's been happening in Europe. Also, colder weather in the US has been coming through, so that's partly it. But I think it's more about the kind of convergence between the markets. To be honest, that's the bigger one. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A, and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.